Good afternoon, friends. Hello and welcome to FinTech Diary, a special show of Economic Times etbfsi.com. At etbfsi.com, we are producing this FinTech Diary and we have completed more than 90 episodes. In every episode, we have a founder or a CEO or a head of a FinTech company who's talking about its business models. Sometimes we also do special shows on the trending topic. And today is a special show specifically about the funding winter. That's what we are going to discuss here. So I do not know how's perhaps the situation or the weather condition in your vicinity or your city. I'm operating from Mumbai, and let me tell you, in Mumbai, it's actually quite sunny. It's quite pleasant also, surprisingly. But I understand that in Delhi and many other cities, it's a winter. It's chilling cold. The reason I'm talking about, the reason the cold and the winter is specifically because we are going to talk about the funding winter. The basic question that everyone has today is whether they don't know whether the winter is cold or not, but there are absolutely mixed reactions specifically on the funding winter. There are fintech investors who says we are going slow, and there are fintech investors they say there is no fintech winter at all. So let me get you the speakers who's going to give us the real weather update in terms of the whether fintech funding winter is real or not. And I'm really excited to introduce you to the speakers that I have with me. My first speaker for this particular session is Mr. Ankur Bansal, co-founder and executive director, Black Soil. Ankur, glad to have you.
Pleasure to be part of this panel. Thanks for having me over.
My next speaker is Miss Nithya Ishwaran, Managing Director, Multiple Alternate Asset Management Private Limited. Nithya, glad to have you.
Excited, Amol. We're going to get a variety of views, I guess, today. So look forward.
I'm sure. Let's add some fire to the winter for sure. My next speaker is Mr. Sagar Agrawal, co-founder and MD Beams FinTech Fund. Sagar, glad to have you.
Thank you so much, Amol. Pleasure to be over here. Looking forward to this conversation with all the co-panelists and with you as well.
Sure. Glad to have you, Sagar. And my next speaker is again a veteran in the industry, the chairman of FinTech Convergence Council, Mr. Naveen Surya, who's also part of PCI, which is the Payment Council of India and IMAI. Naveen, glad to have you. I think there is something wrong with the Naveen, but he is part of the show for sure. I'm sure the technical team will check with his link, and maybe he will be here very soon. But dear friends, let's discuss about the FinTech winter. So I'm sure all of you can see us, and maybe the first thing you must have noticed is nobody's wearing a sweater here. Forget me, I am a moderator and a journalist, but the investors here are not wearing the sweater. They are not having a hot cup of tea or something like that, which simply means that they're not hit by the funding winter or something like that. Perhaps they're not finding it cold. But let me ask a specific question. Is fintech funding winter real? And I will start with you, Nithya.
So, Amal, the answer should be yes, it's a bit chilly. And I just want to give some color on that. We've seen $35 billion of private equity and VC investment in financial services in the last 5 years. I mean, just to put that in perspective, 50 billion was raised in the last 10 years. 35 of that happened in the last 5 years alone. And of that, 19 went to FinTech. So while we are seeing a little bit of slowdown, a lot of money has gone in, specifically in the last 5 years. And let's also remember, we had COVID as well. So despite that, we've had 2 out of the 5 years were COVID years, but despite that, we've had this. But I would say there is a bit of winter. We have seen some of the listed stocks not doing well, especially the FinTech listed stocks. So that has put a lot of questions in the mind of both FinTech founders as well as investors to say what business models will work and how should they progress. All this capital that has gone in there, how should this find itself, grow itself out? So I would say they are in a bit of a transition phase is how I would call it. But we can talk more about it as we go along.
Sure, Nithya. Interesting perspective for sure. Sagar?
No, I think to add to what Nitya said, right, I think I always believe in that weighing long-term merit, right, should produce better results than trying to be trying to swinging with the popularity in the short term, right? And that's where I think is one of the quotes that Charlie Munger always mentions, right? That we need to focus on long term. Is there a winter? Fundamentally, absolutely, right? I think there's a sense of a discomfort, I would say, that everybody has in the market. Um, is it because of lack of capital? I don't think so. I think is it because of fundamental problems in the businesses? That's probably been the case. Not to mention the public markets have been a bit of a dampener, right, as Nitya rightly mentioned, and that's caused a lot of discomfort amongst the private market investors as well. And today, where we are in the journey, right, the valuations look a lot more reasonable compared to what they were early on. So I think from a overall fintech funding as a winter, I personally don't think it's completely there, but there's definitely a little bit of a gap in the market compared to the mindset of the investors versus what the capital that they have in their hand.
Sure, noted your point, Sagar. Good to see you, Naveen. I think we lost you in the beginning. Uh, I will ask a basic. I'm taking a basic questions with all of them. Nitya has already answered. You heard Sagar. I will take the question to Ankur and then I will take it with you. Ankur, your view.
No, I totally agree with both my co-panelists. Funding winter is real, but I still think if you look at the numbers, this year first half is still two times the number of FY20. So it's not, there's a slowdown from last year, but last year was an aberration, I think. Last year the funding was happening at a different pace altogether, but still the markets have taken so much capital. At a global, as a sort of India startup story, if you look at, we have still received $20 billion, which is almost two times of what was received even in entire 2020. So markets have deepened. I think, of course, there is a slowdown, and I believe it's good to have a slowdown because what we forget is that the prime goal of a startup is to build a business and not fundraise. So fundraising is not the only barometer that we should look at. I think it's actually a good thing that all companies as well as investors are focused now inward and try to build a more robust business, which is more critical for the overall fintech ecosystem, right? Because burning money and growing at all cost cannot, cannot last forever. So sustainability is critical, and that's where I think everybody's focus areas today to improve their business model, improve the unit economics, and then automatically as we go in the midterm long term the valuations will come back. So it's good that there is a consolidation period right now because that will help us build stronger fintech companies.
Okay, so Naveen, I think you didn't hear Nitya, but you heard the Ankur and Sagar. So the view that I'm getting from the investors specifically is they're feeling the cold, partly, not fully, but at least they're feeling the cold. I'm sure you speak with a lot of industry bodies, and you're representing an industry body, so you must be interacting with a lot of fintechs. What is your sense? Do you also feel that the fintech funding winter is real?
So I think some people like winter anyway. So depends where you're coming from. And again, I'm a eternal optimistic, just like this Rakesh Chitwala. I believe in India, right? One thing we have to understand that why the kind of growth we saw first in last 3 years happened. The reality is that the India penetration of financial services and market is extremely low. Then banking, just probably a late 2 digits. Look at payments, early 2 digit. Everything else is still single. And this is after a lot of acceleration and growth that has happened over the last 4 5 years. And the way the digital infra has been made in India has made the growth in companies extremely high, extremely possible. When I remember early days, for you to reach to 1 million customers, it used to take probably 10 years. Now you see companies doing it in 1.5, 2 years, right? So there are some real data about India that we need to keep that in mind. And again, the market opportunity. Nothing has changed there. Now, when it comes to probably, I believe winter you're here in a context that whether the funding has a challenge for fintechs. I would again say it's situational, Amol. It's absolutely slower than the last year, which I think Ankur I heard Ankur talking about the data, Sagar was talking a little bit about it. But again, let's not look at fintech in isolation. Look at the entire startup ecosystem globally. Probably there the downward trend is even 80%, probably much higher than just fintech. So when we talk, it's important to contextualize that how is the relative, let's say, growth or a decline in a particular segment, and within that again the subsegments. And again, if you see within those segments, I think challenge has been more around Series A to D, sometimes late stage. The early stage still seems to be doing well. One thing definitely I do agree, Amol, that don't see now every, let's say, alternate week, 10 students or 10 younger executives approaching you saying, hey, here is a business plan. I want to raise 2 million. I'm doing some fintech. Please invest. And I think we all know heart in heart that was required. Everything cannot be termed fintech. I mean, if Infosys was providing a banking software yesterday, they were seen as an IT company and let's say valued on a IT multiples. Somebody does it today, they want to be called fintech and gets a fintech multiple. So net net, there has been some correction required. Also, there are some specific segments we need to keep in mind. One, M&A deals that have happened. This don't happen every year, right? This is a very different trend around. So last year, the number of M&A deals, the big ones, what was the fate of them? Couple of them didn't happen. So has those numbers been adjusted? We don't know yet, right? In the trend that we are seeing. Similarly, the whole crypto ecosystem, which was driving the growth very fast a year and a half back, again, there is an implication. So if you look at all in all, I think it's a mixed bag, but it's difficult to generalize for one segment and the entire sector.
Okay, so that's a detailed perspective, Naveen. Quite appreciate that. So you're right. I think I really echo that one point where a lot of tech companies which are operating in the space, even since maybe 10, 15 years, they rebranded themselves as a fintech because the rally in the fintech is very strong. And I think even the startups also started calling them, those who are specifically into tech, as a fintech company. So quite meaningful thoughts. In fact, the data points that Nitya shared were also remarkable. And we can certainly see some drop for sure. Like I have certain data points where the PEV and VC investments are not there, but if you look at the investments that happened in January itself are $421 million, but in November it's $90 million. I'm sure it's monthly and cyclical issues are also there, but a lot to learn from you. I think honorable panel members here for sure. But before that, let me just ask my audience, if they have any questions, they can share their questions. You can log into any social media platform of ETBFSI and you can watch us live. And if you have any specific questions, please share your question in the chat window. We'll try our best to take that. So let me, come back to now the basic question. If most of you agree that there is a fintech funding winter, now the question is, let's understand, why did we get into the winter? I mean, for seasonal, it's quite obvious, but specifically this winter, we need to understand why. Nitya, let me learn from you. Why are the fintech shivering? Why are they feeling the chill or the cold?
See, I would put it in 2-3 points. Last year was an amazing year for fundraise. So in fact, I would go on to say many smart companies raised a lot of money, which now with the focus on burn is going to take them 2 to 3 years to consume. And we've seen a lot of companies like that. So that was a very good intent. And I would say those are smart founders. They didn't want to come into the market because everybody thought bubble is going to come off of it. So that is point number one. Point number two is we also saw regulatory intervention by especially RBI. So a lot of digital lending companies, or I will go back to what you said, Amol, a lot of companies call themselves fintech, but a lot of them were on the fringes of financial services, I would say. But yet where we had the issues of FLDG, right? You're not really underwriting anything, but you're underwriting something and so on. And you had RBI come in and make some interventions on data sharing, on FLDG, and all of these. So these have set them back by looking at their business model is the second thing. And the third and last thing I would say is last 5-7 years, we have seen money go to set up infrastructure in the case of payment companies, to come up with old tech and acquire customers. Now, all of this eventually has to translate to cross-sell of products, economics coming in, which is what I meant by saying we are in a transition phase at this. Now you've laid the infrastructure, you've got the customers on, and now let's see what you're going to do with these customers, because capital wants to now see economics. And I'll go back to what Naveen said. You're now seeing a spate of M&As, which are also happening. Now, what's happening in the M&As is companies which have the infrastructure now are acquiring product companies because they have the infrastructure and the customers, but they don't have the products. So you see lending companies going in there. So you are seeing all of these combinations, which will also make the capital more efficient. So I think this adjustment phase is happening. One is business model due to regulation. the product companies finding the infrastructure companies and the customer companies coming together. And all of this will take 12, 18 months to settle is how I feel about it. By when time the capital which was raised by the smart companies will also come up for raising. And that's the transition phase I was referring to.
Yeah, quite meaningful, Nitya. In fact, few smart companies raise millions of dollars so they can be sustainable for maybe a couple of years, not just months.
What has happened is the boardroom discussion in those companies, if they were budgeting for 2 years of covering the cash losses, they are now stretching it to 3 years because there's so much focus thanks to this all winter discussion. So the stretch is even longer, right? Everybody is becoming more careful.
Right. Sure. So let me take this question with Sagar as well, and then I will slightly tweak it for Naveen and Ankur. So Sagar, what is your view? Nitya explained her own perspective in terms of why did we get into the winter. What do you think? Why did we get into the winter, according to you?
See, just to add, I think one of the things that we should see in an Indian context, right? Indian market is heavily dominated by international VC funds, growth funds, larger funds from US and Europe who are investing in India, right? And these guys are not necessarily traditional private equity or venture capital funds. They are a combination of hedge funds, private equity, venture capital, sovereign funds, and multiple such asset classes that they invest into or they come from, right? When they have a problem back in their home for whatever reasons, right? The first market they want to withdraw out of is emerging markets. And India is one of the emerging markets even today, right? And I always say that whenever US sneezes, India catches cold, right? And that's the fact in India as well. Whenever there's a challenge in the US markets, we suddenly see a lack of liquidity in the Indian market. This is not the first time it's happened. It happened in 2007, 8, and maybe a bit before Modi, which is 11, 12, or 13, 14. And this is the third or fourth time we're seeing that journey. Even when Tiger Global withdrew from the market in 16, 17, again, there was a lot of conversation about growth focus, less profitability, or profitability focus and less growth focus, right? I think this is an ongoing cycle. That's why funds like multiples and probably upcoming guys like us, right, is needed in the market first to create domestic pool of capital. When there's enough and more domestic pool of capital, you will be able to back a lot more companies in the Indian markets, right? That's point number one. Second, what has also happened is that public markets globally has not helped, and especially in the fintech category, right? The correction in the US market is 50 to 75%, 80% levels in some of these companies. People have practically assumed that these companies are going to go bankrupt. And with that thought process, all the emerging market companies who are imitating these models are pretty much written off at the same time. So that's another challenge that has happened, that what has happened in the US will repeat in India. Well, it's a culturally different economy altogether, right? People have to understand that. Third, I think most investors globally, right, tend to see fintech as tech first and financial services later. While in India also, I personally believe it should be financial services first and tech later, right? Financial services is the most secular part of the economy. That sector never really changes, right? It contributes to 1/3 of the GDP in India and globally, directly, indirectly, right? Even in the public markets, we've got 35%, 35% weight that keeps changing, but of financial services market. So that sector is very crucial. It's very important. People have to look at the sector from a different perspective. I think the way people were deploying capital in the last 3 to 5 years was more tech and then financial services. I think these three things, and obviously, as Nitya mentioned, regulations, right? People don't understand regulations. People assume that regulation will come around if you build a business around it. RBI thinks consumer first and then business second, right? So that needs to change as well. That first financial services, then regulations, then technology on top of that. If you follow that routine, most likely you will not go wrong and you will end up deploying more and more capital in this sector. And as Naveen mentioned, not just in this sector, but all sectors in the tech ecosystem overall.
True. Noted your point, Sagar. I think on the regulation part, I think we have seen what you can say, great scrutiny from the regulator side, whether it's rulings on the digital lending or the PPI framework. And I think regulator has also made a very clear message that they are, though they will support innovation, they will also need fintechs to look at the future regulations before coming up with the innovative products. I think that's one interesting part. Which I think most of the fintechs needs to keep in mind if they're directly dealing with the greater innovation at a large population. So noted your points from Nitya and Sagar. Let me slightly tweak the question for Ankur and Naveen. Ankur, so I will start with this, that we understand obviously whether the fintech funding is real, why we get into the fintech funding winter. Tell us what is the impact of this funding winter that you see on the whole fintech ecosystem? Do you see that the new fintechs will not come? Do you see that the growth of the fintechs will be curtailed because of the funding winter?
No, so I actually feel the other way around,
Mhm.
because anybody who's starting now will be able to build a much more robust business model because he'll have to figure out a business. So I
Right.
believe people were very focused on valuation. Now people will focus on value. If there is value, then automatically valuation will come in. So now everybody's focused on the value part of it. And if there is value, then that's the reason M&A will happen or the fundraising will happen. So from a India story perspective, I don't see that fintechs will slow down, because if fintechs has to be there, because consumption credit are going to be the growth engine for our economy. And more and more our banks have become such big deep partners in the fintech story. It's not that fintechs are operating by themselves, right? Banks, large NBFCs have really partnered very deeply and sort of taken the fintech business to the next level. It's not that the fintech themselves are being able to create such a big loan book, right? They needed this co-lending partnerships to be working with, or whether even if you look at insurtech, wealthtech, all those things are happening with the traditional and the new economy coming together. And more people are adopting digital. Like even if you look at PSU banks now, slowly, even they are adopting, trying to figure out how they're going to start working with fintech. So from a medium term perspective, I don't see that the opportunity is going to reduce. I think opportunity only going to increase, because more and more use cases are going to emerge, more and more vertical solutions going to emerge, more and more things are going to happen on the B2B side, because a lot of things happen on the consumer side. B2B still is very untapped in terms of the market penetration. And India economy is so large, and the way we are growing, by what we are supposed to be 10 years from now, it will not happen without the fintechs happening. Of course, next 3 6 months is going to be slowdown, but as one of the co-panelists mentioned, early stage there is not a slowdown. If somebody will still come up with an interesting product or an infrastructure story, or even things around Web 3.0, or things which have real use cases, even on the crypto side, there would be some investors ready to come in. So it's all about a right business model with a good founder, an idea and execution coming together. Still will get capital, may not get the same valuation, but may not need to raise that kind of funding. Interestingly, what is going to happen is the what Nitya was mentioning about, some companies having a lot of capital, and they're sort of now having longer extension. It is for some companies the other way around, because they had so much burn. Now suddenly they realize not going to be able to raise funding, so they have to slow down, and suddenly you start seeing layoffs. So those things are happening parallelly. It's not, we can't generalize the sector as such, because if somebody had built a real business with good unit economics, he'll be able to still sustain. And somebody who didn't have that in first place, he has to rework the entire business model from the scratch, which he may not have the runway to right now be able to do that. So that's where the M&A opportunities also come in. So a lot of these things are going to happening together, and that's where the consolidation phase is going to be very interesting in the next 6 months at least.
Okay. Naveen, on the impact side, what do you think? What is the impact that you see of the winter?
So before I go to impact, Amol, I wanted to actually go back to your previous question, panelists,
Mhm.
that what caused this winter? I think the answer lies in what caused the spring, right? So the spring were caused based on the global trend, what people have seen in a tech, let's say e-commerce world, pure play tech company. You saw that using tech, you could build models which are inorganic growth, non-linear growth, which could actually be much faster and scaled with lot lesser investment over a period of time, maybe initially very high. And that was proven. You saw Amazon, you saw Google, and everybody wanted to be pie or a part of that kind of a piece of cake. And we saw that the next phase that came in all of that, from a pure play tech to the e-com, next phase was all fintechs. That the same changes is going to happen. So within financial services, and by the way, there's one side question which is actually for your next panel. The word fintech is not clearly defined yet. So whether you again have to think whether it's applicable to non-licensed entities, non-bank, the reality is everybody is a fintech, but different panel. So what causes? The cause is the high expectation of a return. Now, if you look at that, I don't think that the trend in the growth has changed. What has changed is when the listing happened in the US of some of the large fintech companies. So 2 years back, actually, there was a news out very clearly that all the tech companies and fintech companies are bigger than all traditional financial institutions. I'm sure we'll
Yes.
all have seen that slide, right? Visa to, let's say, American Express. And you saw their numbers, and compared to the largest bank, they were very big. So that created a huge excitement and sometimes even a FOMO in a lot of investors and even, let's say, other communities. There was a race to really create a next big fintech, and that came to India as well. And India being one of the only largest market where again a lot more investor can participate relatively easily. Again, if you remember 2 years back or a year back when we had a GFF, FM said that India is one of the highest adoption rate in fintech. So again, that caused even across the globe, even though it's an emerging market. So if you combine all these factors, suddenly everybody wanted to create a fintech. And as all panelists said that it became like a fashion to use a tag. So I'm saying if you leave out all of these, which were needed to be filtered, get kind of sorted, the reality is the opportunity still exists. That is where the expectation mismatch happened. The moment US market crashed, everybody understood that eventually the exit will be only two ways, by listing or by M&A. Now, M&A market in India is still at an nascent stage. Thankfully, in last few years, is emerged and a lot of things have happened. But before that, if you see within fintech space, there were hardly probably one or two meaningful deal in a 10 years period. Suddenly, things have changed in last 2-3 years. We have multiple market deals that are being talked about or happened. So again, IPO was the only thing. The problem is even IPO, all 3-4 companies that are there, which got listed, we know what happened to them. Though I would again point out they're better off than US market. One, in terms of discounts that they have from the IPO. Again, on the opportunity side, the US market is already saturated. India market, the opportunity is still there. Growth. Interestingly, you will notice none of those companies have declined in their or in their have done badly in their performance. So somewhere probably it's about reset of adjustment and expectations on the return more than anything else. Now let's also put more of a macroeconomic situations where again large ticket size money. This whole Ukraine-Russia war. I mean, I've talked to some of the large fundraise guys. The time taken in between during that transition period and policies, various funds, that which companies to invest, whether there's any link to Russia, etc., that delayed a lot of things to 6 to 8 months, especially the big size checks. So there has been some additional elements that has again caused certain implications. And like Nitya also said, the smarter guys draw money, right? That was the best thing that could have happened. So I just wanted you to kind of keep that also in mind, that why this causes a winter. Now coming to your impact, I think impact is mixed. More like I said, I'm not seeing every week 5-6 youngsters coming and saying, "Hey, it's an next fintech." You're seeing a lot more diligence done by these people, a lot more thoughtful. And I would just make one quick point that I don't think regulatory excuse is the right excuse. That's like when you can't explain something, it becomes an easier way because that's what media writes, so you could just point it out. You have to explain less. I mean, being on a founder side, I can tell you that that's not real. I mean, that was always the case. There was this clarification. So impact, yeah, I think startup, people have got cautious, but funding still is good. Bridge, I think it continues to do well. Series A, pre-Series A, we see some bit of a challenge, some more diligence. I think late stage DE, I think even more diligence because they're a lot more closer to market, and everybody is trying to understand what multiples are currently and what they were at the IPO time, and then where does it kind of settle. That still is an unanswered question. I'm sure other panelists, if they have some view on it, they can share. But I think that is still a piece which is a question mark, that how would companies be viewed on what multiples. So those are kind of areas where there are, but thankfully M&A sectors should do well in next 12 to 18 months.
Sure. In fact, that
just to add, Amol, just to add one perspective over here, and I think from an investor perspective, what we are also seeing one more challenge in a market like India, right, compared to a developed market, is that in US a $5 to $10 billion exit is pretty common. Or a $10 billion plus exits are pretty common in the US markets, right? In India or other developed markets also for that matter. And in India, I think if you see consistently in the last 16 tech IPOs that have happened, right, they all listed in the range of $5 to $15 billion, but they all are below $5 billion today in the market cap. So as a fund manager, if anybody who has to enter at $500 million plus valuation, then there's just too much very limited margin of error and too much risk on the table for us to generate our desired returns on our investments, right? So that kind of also puts a higher valuation, a challenge for us to keep giving despite the company whether performing or not performing, right? I think people are moving more towards the lower end of the range, which is $100 to $500 million bucket, to make sure that the returns are, or at least the risk-adjusted returns are substantially higher for all of us.
Okay. So, I think really meaningful conversation. So Nitya, let me come to you. So when we understand that at a secondary stage, where the fintechs or the startups where they are really mature, there might be a funding issues, but at the beginning level, primary level, there are no issues. You specifically come into the secondary part. You have invested in, being a PE investments. You are actually have a great portfolio like Echo, Delivery, Licious. What strategy are you adopting now? Are you going slow, if I ask you specifically? If not, how are you reviewing the whole the fintechs today in terms of investing into it?
In fact, Amol, I am more positive now than I have ever been, because few of the times when we, as you rightly said, right, we invest when the fintechs have grown up a bit. I wouldn't say we are late stage, we are early growth. So we are the crossover investor between VC and PE. That's the space that at multiples we have taken. But even at that point, we have to answer these questions, which Sagar alluded to. You are a $500 million investment. Can it become a $3 billion exit, right? And to get to that $3 billion exit, what are the economics that need to play, and so on and so forth. So the way, and that is one question. The second is, we have been inherently believers in the full stack model. What I mean by that is full customer ownership, owning both sides of your balance sheet is absolutely critical. And I think without that, the degrees of freedom that any business has, especially a financial services business, we see fintechs as financial services business with a led by tech, but fundamentally financial services, the degrees of freedom you have are very low. And we are operating in a high CAC environment. So you are acquiring customers at a high CAC. You need to be able to do cross-sell. The classical things that banks do, they did it in a different way. Fintechs have to do it in a digital way. And if you don't have all the degrees of freedom, if you just say, I'm going to acquire customers and put it on the books of banks, your degrees of freedom are very less. If you say, I am going to acquire these customers, these are my customers, I'm going to keep the risk, I'm going to give some risk, maybe by co-lending or securitization or otherwise, but I'm going to keep some, you have a lot more degrees of freedom to play with. So I think this full stack thinking is now coming in much of the fintechs, also triggered by regulation. The regulator has also come in and put in, I'll disagree with Naveen there a bit to say, that has been a big change, the mindset change from both fintechs and regulators. So I'm very positive on that. Second is this whole, I think Ankur alluded to it, to say this little bit of slowdown that we are seeing is making people have a lot more respect for capital. And I think that's a good time for investors to enter, because even founders are going, they're all saying 6 months to cash break even and 12 months to cash break even. I wouldn't have heard that last year, for sure. People were a lot more gung-ho about things. So, both of these. And third, I totally agree with what Naveen said earlier. I believe fintechs add real value. So it's not just better UI UX. That's not what we are talking about. I feel they are able to offer real customer value. We have seen, you alluded to ACO. In ACO's case, there is real cost reduction to the consumer on the premium, as well as better claims. If it were only one end, then there is no economics, unless the other better claims experience is really coming about because of B2C. So I feel real value is there. And that real value has to now reach that balance of saying, in 12, 18 months, I can get to that break even. And the moment some of the better companies start doing that. So we are tracking a lot of companies. I have actually gone out and said that with these three things aligning, I'm feeling more positive than ever before. And so we hope to do some investments maybe in 23.
No, I'm sure. I think by looking at your positivity, your inbox will be full by a lot of startups and who will be sending their proposals to you for sure, who was watching this show, Nitya. So I think on the positivity part, and the real value that you spoke of, I remember two important quotes, because for me, that was a headline. We journalists look at the quotes as the big headlines, right? So 3-4 years back when I met Sanjay Mehta, the founder of 100x.vc, he said that though fintechs are creating real value, they are still eating the leftover and the bankers are eating the cream, because they're not perhaps getting the money or the funds which they ideally should got. But when I spoke to him very, very recently in one of the show, Fintech Diary, he says now things are changing. Now at least banks are looking at the real value which the fintechs are creating. So I really could remember the real value part that you said here. Ankur, let me come to you, and I will little spin the question that I asked to Nitya in terms of the investments. Now, again, your structure is also different because you are into, debt solutions to new age companies and not directly PE or, a typical investments. Have you seen maybe a rally in that side? Because the direct investments in return of equity has been maybe reduced. So have you seen the rally in your side specifically from the fintechs for the funding?
No, so when it comes to debt, since we are sector agnostic, not only fintech, every sector today in the startup economy sort of looking for capital. So I said capital, not just equity. So any kind of capital, people are more than happy to now take on. And as Nitya rightly mentioned, the respect for capital is very different now. So it's again capital, not just equity. So it's like, so from that perspective, debt used to be a very alternative thing, right? People used to use it depending to their business use case. But for fintech, capital is raw material, both equity and debt. So we always had a very deep relationship with the fintech space because they had their NBFCs, or even the fintech platform would need the funding to take care of their FLTG deposits, etc. So there were good use case from fintech space. And today also we would have almost 15-20% of our portfolio towards FS space. In terms of our volume, that has always been consistent, and we try to keep working with businesses which have a real business. So I keep repeating on that part because, as you rightly mentioned, many businesses are working for the banks, not for themselves. So the economics are very much in favor for the banks. But today, they have started realizing with the change in guidelines and all, they have to also start making money. And so the both things have happened together. The fintech slowdown on the funding side as well as the guidelines have come together. So it's almost like a double whammy for them to figure their business model out very quickly. So business as such from volume perspective has been high. The underwriting standards are only increasing. And I think from it cannot be a better time for any investor to actually invest because you will see real grit in a business of time, and with the guidelines coming, it's very clear what one can do and what one cannot do. So it becomes much more interesting from a model perspective, which is scalable because there's not an interpretation of guidelines on the basis of which a business model is being made. And now it's very clear cut what you can do, what you cannot do. So it's at least you should be on the right side of it. So from a short-term perspective, there is a lot of deal flow and selection criteria, underwriting requirements for us always remains to be a little high.
Sure. Noted your point, Ankur. There are a couple of questions I have received. I will take this question. The question is, will the investors now focus more on fintechs rather than tech fins? This question is by Mr. Sumit Khanna, who's the COO of New Credit. Sagar, do you want to take this question?
Absolutely, Amol. I think Sumit, thanks for that question. I think investors have always, at least as Nitya mentioned, we also are a crossover between private equity and venture capital, right? When you think about financial services and when you think about fintech, we always think about financial services first and then tech on top of that, right? So for us, it's always been the case. I think in the past 3 or 4 years, right? Especially with a lot of capital available at the early stages, a lot of people could raise money who shouldn't have raised capital, and that was more of a factor of the market and more of the function of the market. I think when we look at investments, right, any of the investors, including us, we look at multiple things, not just the financial services bit of it, but we also make sure that the team, the quality of the founders, the seasonality of the founders, the kind of business model they're building, what kind of collaborations they're doing, how are they building a better platform, sustainable business from a 10-year perspective. So multiple things go into our thought process beyond just looking at tech fin or fintech for that matter. I think all of these factors come together for us to decide. I would like to say definitely that the market is a lot more deepened. If you look at the last 10 years, right, more than 75,000 companies have raised capital, of which I think close to 700 to 800 companies are there today who have scaled up to become a growth stage company. And that I think I would say 150 to 200 companies, which are what we are tracking, are technology, financial services company or fintech companies, whatever we can call them. But there's a depth lot more over that. 170, 180 companies is a strong depth for us to pick and choose from. And that's the kind of companies we would be backing during our journey. So I think you will see a lot more investments happening in 23, 24. But the quality of the companies would be very high, the quality of the founders would be very high, and the quality of the business model would be very high.
Okay, sure. There is another question. I think the sender's name is not there. Naveen, can you take this? The question is specifically about, are the investors, VCs finding it difficult to encash the value out of what they invested in fintechs?
Well, it's again, there's no general answer, and I like both Nitya, directly Sagar, and I covered earlier that everybody's trying to reset expectation on the returns, the investment at which level they enter, and what is likely to be the exit. Earlier, everybody was thinking that 10 billion to 50 billion might be an easy exit in an Indian market. I'm not saying it will never happen, it will happen again. But the current cycle, the way it has gone, they said that on the downside, it could also be 3, 4, 5 billion. So let's just reset the expectation. Whether the people are making return or not, it will entirely depend on at what stage in different companies they've entered. Net, I think still most investors would make money because, again, as I said, they have gone through multiple cycles already in the India, and many of them are seasoned, especially he's talking about VC. VC ecosystem in India is fairly mature. They've been in India now, kind of, at least I've seen them over a decade now. So I think they've already seen 2 cycles, and maybe Nitya can add more details to it. I think they can leverage the portfolio, but absolutely the expectations are going to get reset in terms of returns.
Sure. Nitya, you want to quickly add?
No, Naveen has said it all. It's going to go in sync with this, right? If we are typically, we've also seen that primaries and secondaries go together because you tend to evaluate the company, the management is available. There is a set benchmark setting which is happening by the primary, then the secondary happens at a little bit of discount to that. Here, what is going to happen also, and I think as investors we should be sensitive, is that if the company needs primary, let it get the primary first. There's no point crowding out the primary by trying to push the secondary into it because capital is raw material as far as fintech companies are concerned, right? Critical raw material. So I would say a little bit of that patience we'll have to show, as I'm talking about the general investing community as well, while this transition that Naveen referred to happens and people settle on what really the valuation benchmark is. What is this new business model? Amol, what has happened is a lot of investors have come in thinking it is capital light. That is how they valued the companies. Now, thanks to everything that's happening, including regulation, suddenly they have realized, oh no, it's not as capital light as I thought. These companies need capital to now grow further from here. Yes. I mean risk capital. So that also is an adjustment because you thought it is, I can leverage 1:10, but actually you can leverage only 1:5. That means your ROE is going to come off or it's going to take longer to reach your benchmark ROE. So all of that little transitions have to happen. And I would very much hope that the investors are patient. Either if they're impatient, then M&As have to happen. Or if they feel the company is, will sort itself out in the next few years, then let the primary capital come in is how I would put it. And once the company grows, the secondaries will start happening anyway.
Okay. So basically from the investor side, there was a funding monsoon, right? Because most of the investors came into the system and they wanted to literally pour the money. A lot of family offices came, a lot of VCs came. In fact, I can share it with you. We used to also receive a lot of press invites, not only from the fintech companies, but also from the investors that they want to invest into the companies. But again, let me add and
Well, I had one comment. Sorry, I'm interjecting. See, this understanding of fintech being this light capital, etc. And I don't want to comment on specific funds. Right. And that's where probably we agree to disagree on the policy alone or not being one of the key factors. I'll give you one example. Let's say if we discuss some investment somewhere from a company which is inherently in a lending space, right? And let's say if they are getting valued 50x of the first question will always be that what's the journey for that company? They are in probably sourcing customers. At some stage, they will have to be NBFC at a certain stage. How will they get valued? They will eventually get valued on that book value, and eventually they will need capital. So, if you did not factor it when you were doing investment, and I would probably agree that mindset if you were not VC and let's say PE and let's say seasoned investor, if you were just an angel. But if a investor, and again, I'm not talking any specific name, who is a seasoned VC++, if they make these kind of assumptions, then I'm sorry, I think then there's something fundamentally wrong between all our investment community. So I'm sorry I'm being harsh, but that's a reality. You cannot not. And let's not forget, the convergence between the real financial services model and pure play digital will happen. The digital will learn the fin part of it, the fin will run the tech part of it, and somewhere they will settle maybe to a newer benchmarks. But they will never work completely in opposite direction, maybe for a 2 or 3 or a 5 year period. So these are anyone who's seen 4 or 5 cycles will reach that particular maturity. So I just want to make that one quick point.
Yeah, totally.
Sure.
Naveen, that part of that happened because in a bull market, you know what happens, right? In a bull market, you have season and a lot more investors join. Not all of them will truly
Understood.
understand.
That's why I just wanted to highlight that if you look at just the tech play and you think that's the business and that's where what will create probably $1 billion company, then the analysis itself is wrong. That's all I just wanted to point out.
Totally,
Right.
totally.
So, Sagar, again, let me drag this a little bit and take your views also. You are an Ankur's. So, I will slightly tweak it. So, considering or, given the fact that what Naveen and Nitya said, and the question was about, obtaining a value or maybe encashing the value out of it. So the basic idea was we'll invest into the companies, they will go to the stock market. I mean, after maybe 4 or 5 years, and we'll get some value out of it, which is not very true because most of the companies which listed into the stock market could not generate the value which the investors and also the all the shareholders projected. So do you think that the investor psychology of encashing the value has also changed now? Sagar, first I will take your views and then also I will go to Ankur on the same question.
See, I think India traditionally has seen three exit routes, right, or encashing routes, I would call it, right. One is either public market is a prime market for exits, where you get the maximum benefit of the valuation if you build the right company and gone to the market with the right valuation. The second segment where we have seen the most action in India has been trade sale or sale to larger managers, larger private equity funds or maybe international private equity funds, right. And thirdly, to an extent, M&A. I think in all three categories, and if you look at financial services as a sector, historically we've seen multiple exits across the three sectors, right? We've invested in Centurion Bank of Punjab in 2006-7, and which we sold it to HDFC Bank. There was a M&A happened. We've taken companies public. We've done trade sale to larger managers, right? Across the board, there's been historically been cases. The question is that when you are exiting, is the guy who's coming in, is he going to eventually make money? Right? What is his horizon? What is his journey? 5 years, 7 years, 10 years, right? Across all the investors who are coming in at this round or the next round, they're looking at the same thing that we are looking at it. Can we make enough return from this point onwards? The question I keep asking founders is that why do you want to price the company to the top of the value today and not let any investor think about the next 5 years or 7 years or 10 years, right? If you want to think about the next 5 years, 7 years, 10 years, everybody will make money and everybody will have opportunity to encash every now and then. So I think the market will evolve gradually. IPO, I think, will probably remain slow for the next 6 to 9 months, definitely. So for us, I think we're looking at a 4 to 5 year journey, at least from every company perspective. I think trade sale to larger managers will happen a lot more. I think managers will, at least the guys who are sitting on a lot more capital, will see a lot more value deals. Because there are funds who are coming at the end of their life cycles. There are funds who are probably struggling to create exits. They would want to sell their portfolio companies out. So the combination of primary and secondary will happen. I think M&A, if last year the biggest deal would have happened, right, that would have opened up the market big time in the fintech space, which didn't happen for whatever reason. I was really rooting for that transaction to go through. But I think gradually it will evolve. Our 2025 unicorns, which are there in the fintech space, or the companies which are $1 billion plus in valuation, they will start becoming larger and larger. And their growth will start coming from acquisitions of players who are in the 500 to $1 billion category. So I think exit routes are going to open more. International guys are not coming to India yet. They are building rather than buying. But I think gradually you will see a lot more buying happening than building. So all three routes will become stronger and stronger over a 5 year, 6 year period, not an immediate short term 12 to 24 months perspective.
Okay. Quite a valuable points, Sagar. Ankur?
Yeah, hi. So on exits, I think right now nobody is really looking for exits unless you have no other option. So it's not the market that one is trying to get the right kind of situation. Today, I think most people are focused on portfolio management, getting the companies ready for maybe an exit a year down the line, unless there's no other option, unless the company is less than 6 months or 9 months of runway and they have to go out in the market and raise. So today it's all about stability and trying to come to a situation where the business can be in the new, as we say, essence of showing the profitability track record, as well as becoming compliant and regulatory wise completely in sync with that. So that's where sort of products like debt work very well. Sorry, I have to jump into this entire conversation, bringing my own perspective. Being a lender, it's wrong for me to not bring that up. That helps us to take care of no volatility, right? Because as a lender, we have fixed returns, so the equity valuation can go through changes, but you end up getting your returns that you're supposed to get because of amortizing loan structure in your continuous cash flow. So, but from a overall perspective, it is, we have to wait and watch. There is no doubt M&A is going to increase. I think for large private banks, it's going to be great opportunities where they might find some interesting companies that they can bring into their fold. Like for example, I've seen one company where they have like very large AUM and 80% of it is with that bank, and now they're out of runway almost. So it could be a great opportunity for them to just fold that business into it, because there may not be many opportunities out there for them to fundraise today. So there could be a lot of interesting distress opportunities coming their way, and if they are able to find a way to work between themselves, this could be great value creation for the strategics out there. So more for Indian strategics today, those who have healthy balance sheets and a strong business model. Otherwise, it's going to be a bit challenging for smaller fintech companies which are in the Me Too space, because on the Me Too side, there are so many lending businesses out there who could not scale, and they become great M&A targets. So in those situations, most investors will end up just getting possibly their capital back with maybe a small IRR.
Okay, noted your points, Ankur. So now let me ask one specific question to all of you, very quick. And Nitya, I will start with you. So obviously we discussed the winter current challenges, why we got into it. The immediate question now is, and everybody would like to know this. Obviously, partly few of the panelists already answered this, but all of you could put it very, in a short or brief, is how long this winter will continue? When will we see the summer? Or maybe the monsoon funding?
No, I think overall, for us to come out of this slowdown is at least going to be a year. But I do feel that a lot of lending companies after 6 months will have to start raising capital. So they all have to come out and test the markets sooner. But that's the timeline. 6 to 12 months is how I would put it.
Sure. Sagar?
I think I would say, if you look at the two largest markets in the world, right, or at least strongest markets in the world today, from a thought process perspective, it's India and the US, right? I think a lot of people would not touch Europe and China and other parts of the world, right? So capital will eventually flow to India, which means fund managers will get more capital, which means they'll have to deploy, right? We also have deployment pressure at the same time, whether we like to say that or not, right? Less so, given that the valuations are a lot more attractive. I think we're seeing very high quality businesses right now. There's sensible founders, seasoned founders. We are very excited about the next 12 to 24 months. I think a lot of, I think $4 to $4.5 billion of dry powder is there, Amol, in the market today, with VC funds and private equity funds. All of them would be looking for deals. All of them would be looking for high quality companies. So there would be a lot more deployment of capital. I think good companies will always raise capital at good valuation from good investors, right? Those three things never change. So I expect a lot more announcements. Yes, we'll be cautious in terms of who we back and why we back those guys.
Naveen?
So instead of giving timeline, let me give you some closing kind of a remarks. One, let's not forget that the investors made money during IPO. It's not that they didn't, they exited, right? And there was a joke that the cashback that all the customers were getting now, I think they're paying back in the IPO. So I don't know whether you heard that joke. So it's all gone back to where it came from. So let's not forget this. The challenge for you is the public market sentiment for when you go back to IPO next time for the new benchmark. So let's keep that in mind. Second one, keep in mind is liked by investors because they get best. They get better companies, they get high quality, they also get good consolidation opportunity. So I don't think the challenge is with the investors. What happens is if you are in a fundraise mode as a company, then you have to be extra careful, which means your expectations around multiples, around your final business model, about no excuse of not knowing or what's likely to come in regulation. The reality is all those regulations exist, right? You may get some leverage, some temporary arbitrage, but you have to factor in that that's going to be for long. So it's just about that correction. As we said, in a Gartner hype cycle, you see the hype and then you see the plateau of productivity. I think we're just passing the plateau of productivity and then back. I want challenges around market and you back in 6 to 12.
Okay. Sure. Ankur?
Yeah, so I think I think it's almost anybody's guess how long this will last. It could be 6 months, it could be 12 months, it could be anywhere in between as well. But I agree with Sagar also. I think a good company will be able to still raise capital. So if anybody is reasonable and pragmatic, will be able to raise the capital. And I think one point that I may not have made out is that overfunding has killed many businesses, I feel, today. So possibly people will end up raising more right size funding and do a business which is right for them. We had one of our fintech founders, they mentioned, I don't know why they need hundreds of people in the tech team, why it cannot be done with a smaller size. So focus on product. Tech needs to be critical. Like suddenly we are seeing so many layoffs happening, but the business will continue running. Suddenly we are seeing marketing expenses have become almost to like 20%, but still the business is still running at the same pace. So all this capital which was being used for just trying to create scale, but it didn't really go to the bottom line. All those experiments are being stopped and people are going back to the drawing board, which is critical. So if somebody's got that recipe right, they will find enough I would say people in their restaurant to come and buy from them. So that's never going to be a challenge. Because fintech story is not going anywhere for sure. If we think in the Indian story, it has to be fintech has to be there as well, because of so many macro things we have already spoken about. But it may take, for the broader ecosystem from an overfunding perspective again to come back, may take a longer period of time, because then we need again some very big late stage investors coming in and writing big checks and again giving them crazy valuations, which sort of, I believe in the long term spoils the business, right? Because that's not what people are looking for, and suddenly businesses get overvalued, and then it is like a never-ending cycle.
Very realistic and quite meaningful, Ankur. I think I'm almost done, but I have just 1 minute left, and let me see whether Nitya gives me another headline here. So, Nitya, let me ask you a very important question. Please give me a headline. Where are you investing now? Which are the projects in the pipeline?
Okay.
Come on.
We are okay. You want a headline? Okay, let's see. So we are. I've just gone out. I was telling you, I've just gone out and said that we are from our next fund, which is Fund 4, which we start in Jan 23. I've gone out and said I want to put out $500 million over the next 3.5 years, roughly 3.5 years.
Okay.
I do believe that more than half of this, maybe at least half of this, will go towards what we call fintech. Soon we'll be talking, it's a continuum. Fintech, financial services is a continuum, and soon we will not be differentiating, but for today. So I think a lot of people spoke about the penetration story, and I totally believe that. So small ticket, loans to consumers and to SMEs are definitely up there. There is a lot of penetration still to happen there. So I'm excited about that. I'm also excited about insurance, with the IRIDA coming in and really opening up and welcoming investors. So I think we'll see a lot more tech-led plays there. So right now, these two are the top of my list to look out for.
Sure, I think that's quite a content for me, Nitya. And thank you so much. I think everyone, Sagar, Naveen, Ankur, and Nitya, once again for sharing remarkable perspective. I must say this was really, really meaningful and realistic. I think you opened your heart and really gave some good meat here. So thank you so much for sharing your inputs at FinTech Diary. And dear friends, thank you so much for watching this show. Wish I could have taken more questions, but there were not very specific questions, so I didn't take them. But thank you so much for watching FinTech Diary, and thank you again, ladies and gentlemen, for joining this show.
Thank you, Amol.
Thank you.
Thank you.
Thank you, Amol.